When it comes to the like MACD and the RSI for entries or exits, uh, there are certain stocks that it works well with and certain stocks that it won't work well with. So if you find you're getting like false entries and it's not working maybe the majority of the time, like 3 out of 4 times, it might be that stock that you're on. You might want to pick a different stock. So that's a good tip for you on that.
Okay.
Yeah. It's there's there's nothing that works perfect. If there was, there'd be someone who owned the entire planet at this point. You have to be good, and you have to be adapting, and you have to be improving all the time.
Yeah, I agree.
Yeah. So that's cool. So did you try any of that out today?
I did it on a, I think it was DraftKings.
Oh, DraftKings. Uh-huh.
Mm-hmm. And that went well. I won $60, so I started small, but I
Cool.
earned $60, so I was fine with that.
Yeah. Let's see. Let me pull up like the 5-minute chart so I can see the whole day. So when did you get in? In the morning or?
Yes, in the morning.
Yeah, and it pretty much just went up from there.
Yep.
That was really good. Well, and did the RSI or MACD inform you to go in?
Yes. Yep.
Cool. So it worked.
It worked today. I mean, yeah, like it worked
Yeah.
today, but it could
Yeah.
be different tomorrow.
Yeah, you never know. Like, it's really easy to make money when everything goes up.
Extremely.
You don't get to learn if you need to improve somewhere if it's going up all the time. And the one time
Yeah.
it goes down, that's when it's going to bite you in the butt. Yeah, so cool. Does anybody else have any questions? Anything interesting happened today to you guys? That's pretty cool, De'Ara, that you had a trade work. Oh
Yeah.
yeah,
I think it was another
Today was
one.
a good day for me. I think it was a good day for a lot of people. What were you gonna say, De'Ara?
Oh, and I also did Amazon. I had a call on Amazon.
You did.
Yes, I got in at 10:14. No, 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 that's a lie. I um I got it at 9:37 and I cashed out at 10:15.
Okay, so just like a 35 cents.
Yeah, I had a profit of like nearly $300.
Uh huh.
So I was fine with that one too.
Okay, cool, cool. Yeah, Amazon did really good today.
Yeah, it seemed like I pulled out too early, but profit is profit. So
Yeah, I mean, if you had let it ride like all day, I think it would have been fine. But you can never know that for sure.
yeah.
But in retrospect, yes. And yeah, I was in Amazon all day today, and it did great. So let me see. Anybody else have any questions, Dr. Yusuf or Aoun or Karon? And are you able to see my screen pretty good this time? Everybody? Yep. Okay. Karon, yeah, what's up? Were you going to say something? Your mic got unmuted. All right. So, let me show you guys something now that I've got a couple of. Yes, hello? What was that? Okay. So, let me show you guys something interesting. Well, actually, first things first, you can take a look at this. So, if you had gotten in Amazon 1 year ago, I think, let's see, so that would have been somewhere back 18, 19, where's the years here? August, July, June. So if you had gotten into Amazon about 1 year ago, you would have made from the entry point to the high recently 101% return on that, difference. However, had you gotten into Amazon every time that Amazon pulled back down and then just waited a couple days to sell a couple days later after it went back up, there was 15 times where that happened this year, and you would have made 740% in total. So that goes to show, how much potential there is in swing trading versus buy and hold. And one way you can figure out where to get in is with the moving averages. So say the 20-day moving average. I'm looking at a daily. And this thick orange line is the 20-day moving average. So every time Amazon pulls back towards that 20-day moving average, let's see, I'm going to try to mute a couple in case we got some noise coming. Okay, that should do it. Every time the price pulled back towards that 20-day moving average, if you had entered and then waited a couple days, Amazon would take off, and just like on that one, in 5 trading days, it went up 17%. So if you did that every time it pulled back to that orange line and then sold after it went up about 10% in stock price, you would have made 740% on Amazon that entire year instead of 100%. But check this out. If you had done it with options, you would have made 10 times that, because options can return approximately about 10 times the returns that stock can, as some of you know. So that's kind of an interesting thing about, I just happen to have that up. Kind of an interesting thing about stocks is that swing trading can be very profitable on stocks that are reliable. You need to pick stocks that are reliable in how they go up and up and up and up and up. Take a look at Microsoft, for example, over the last several years. I'll show you a beautiful chart. Let's have it pull up. It just takes a second. Sometimes the MSD, or let's try another one and then switch back. Okay, there it comes. Okay. So look at that. That's a chart of Microsoft over the last 10 years. And you can see it just goes up and up and up and up and doesn't really struggle. Like if I showed you Ford, that's the last 10 years of Ford. That's bad. It's down and down and down. In the beginning, it's like up and down and up and then down, 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 down. But the thing is, look, it goes up when it goes through these down periods. Whereas Microsoft, switching back to that one, it doesn't have that much of the extremes. It's not it's a little bit smoother, quite a bit smoother. And that's a really good example of Microsoft. So now that you would know that Microsoft is a good, reliable stock that just always performs well, and it doesn't struggle like other stocks, then you can find those moments where it pulls back and enter, and then wait a couple days for it to go up towards the other side of where it always tends to go up, and sell around there. Then wait for it to come back, enter again. And then you can just do this over and over and over. And Amazon is a good example of that, returning a really good amount of money. That is, kind of the basis of a lot of swing trading. Does anybody have any other questions? 4, 5, 6, 7, 8, 9. There's about 10 of you here. So if you think of something that today you wanted to know about, let me know. Let's take a look at like what SPY did today. So that's the market, the entire market. So that might be a little bit hard to see because the little like lines are very thin, but this allows us to see like how it came up yesterday. If you remember yesterday's trading, it was like scary going into the beginning of it, and then it fell. It found bottom. Then we had the double bottom, and then the triple bottom, and then towards the end of the day, it went up. And then overnight, it stayed right there, but in the morning, it went up even more. And then when it opened today, there was a lot of profit taking going on, which I predicted. And so a lot of stocks just started falling because everybody wanted, who would want to hold on to a stock in a market like this? I mean, it's just basic psychology that it's an easy guess that when the market opens and it's up in this crazy moment of the market, that anyone's going to take that money off the table right away and just let the market and just see what happens after that. And sure enough, the market fell and it eventually sort of found bottom and then started to rally from there, and we had a really good day. I can go over some of that price action, or if any of you have a question, I'll let you ask it now, because the price, going over the price action can be pretty detailed, so I don't want to take up all that time. You just unmute your mic and ask your question. Are you able to unmute your mic? I think so. All right, well, then I will show you kind of like what we have here as far as price action. So it opened up right here at 328.56, and you can do this kind of analysis on any stock, okay? But we're just going to do it on SPY because these trends are really clear. And it went up. I'm going to zoom up to this so you can really see the close-up detail. And it went up at first, basically over the first 4 or 5 minutes. These are minute bars. And then pulled back, but not as far as it had hit in the previous minutes. So in other words, in the second minute, it did go down briefly, made a low from the open, then it went up a couple minutes later and made a higher high, and then when it came down again, at that moment anyway, it was a higher low. So by this minute, you're kind of feeling that it's a potentially trending upward. But that next bar then came way down and made a lower low. It turned out to be a little bit of a fake out, but that basically should tell you that the market or the stock, whatever you're looking at, definitely has the potential to go down now. The trend is saying lower low than the low I just gave you, and so that's a lot of uncertainty. Then the price rallied back up to a higher high. So what's happening here is expansion, really, which is the price is going in kind of a opening up triangle. It's getting wider and wider. But what you really want to pay attention to is,
how are you deciding where to draw those lines from?
okay, so there's a bottom point here going on with those lines, right? And there was an upper end of those rallies, kind of like right around there. But they all emanate from an original focal point right here, okay? And when you're talking about price expansion, there's almost always a middle point, because what's really happening is people are saying, yeah, sure, I'll pay a little bit for that, and then it pulls back and people are like, oh, yeah, I really kind of wanted to wait for a little bit of a lower price, and then it goes way up higher, and it goes, well, yeah, I guess I could pay a lot bit for that, and then it goes lower, and people are saying, yeah, I really wanted it to be even a better price. So basically, it's just oscillating back and forth and getting worse and worse and worse, and it's expanding, and yet it hasn't really taken direction yet. So that's why I knew to create those particular lines, okay, as like a triangle like that. But normally, you'd want to create like a channel, which is showing like what the low prices are doing, Okay, that intersects all those bottoms, and what the high prices are doing, the highest points are doing. So you kind of see it like that, okay? But anyway, so then after it hit that higher high, boom, bump, boom, bump, it came down and broke both both of those lows. So at that point, that's it. I mean, any uptrend is broken right there, because the price went below all the lows that had previously happened after it had made higher highs. And if it does that, that negates out the higher high potential and possibility. So that, as you can see, would have been a great point to enter like as a short. So get puts, buy SPY puts, or buy puts on the stock, whatever it is, or go short on that stock if it's not too expensive. And you can see that this is called consolidation. When consolidation happens, the trend is still continuing. It's just pausing. It's just breathing for a minute. So that little range right there, get off of there. Okay. That little range right there is consolidation. It just means that price action has paused for a second. All the big sellers or big buyers, if it was going the other way, that were previously interested have already committed all their money, and now we're waiting for some just more interest to come along, and then some more interest does come along, and the price continues. So whenever there's consolidation like that, usually 80% of the time, the next move, if it's going to be extreme, is just going to be a continuation of the previous trend. And here we have that broken out uptrend, which means we're in a downtrend. And so it consolidates. This is a great time. You had 4 minutes. You had 3 minutes to buy puts on SPY. I did buy puts on SPY at that time and made some money on the way down. But you had 3 or 4 minutes to get in there. And if you can get in on this break here, that's an even better point. And it's great to do puts. If you're ever playing puts, it's great to play puts on SPY because SPY represents the entire market. So when SPY goes down, it's like the pain of the entire market happening all at the same time. It's really bad. When the SPY goes down, panic and pain starts occurring everywhere, and it just makes it worse. When SPY goes down more. So you get these really big thrusts down right there.
So quick question, if you were to buy a put at that point when you saw the break going down, like you said you might have also earlier today, what would you be looking at, a weekly, a daily,
Okay. Okay, that's a great question. Yes. Okay, cool. So when it comes to what option to pick to day trade, so if you know you're going to day trade the option and you commit to that, you don't want to convert that into like, okay, I'm going in this for this little scoop, I'm going to day trade, I'm going to be out, and then yet somehow say, hey, maybe I'll stay in, and maybe I'll hold this over through the next day. You got to stick to your original thesis. Okay, is this a day trade or is this a swing trade? So once you've decided, okay, this is going to be a day trade on anytime you decide to day trade with an option, you want to choose the most nearest expiration, because you're only in it for just a little bit of time. And so you don't want to overpay for no good reason. You don't want to pay for all this extra duration because as I talked about in the previous learning session, the duration you choose is like your rental fee for, like, if you're going to rent a car for a month, it's going to cost a lot more than if you rent it for the day. So you want to choose the shortest duration, and then you want to choose typically at the money, but I'll give you a little bit of an expert tip. When you know what price direction, when you know what direction the move is going to go, and that's what you're trying to make money on, you can actually get an acceleration of returns if you choose a strike that's kind of like just out of the money as far as that's concerned, so that the move intersects it and goes in it and through it. So in this case, it consolidated at 328, and then would fall to 328.10 and then 328. So you might choose the 328 because you know that the price is going to fall through it. When you do that, you get this really nice parabolic curve on the delta, and you get these accelerated returns, and it's a bit better. But I mean, just as a general rule, just choose at the money. At the money. So if that was the closest strike, that's what you would choose, 328. Or if it was kind of saying that at the money was 329, then choose the 329 or whatever that stock is that you're day trading that day. But one other thing you need to think about with day trading options is make sure it's a very liquid option scene. So like most stocks that are not highly liquid don't have very liquid options, meaning there's not a lot of activity. But that's not entirely true. Like for instance, Party, PRTY, and some small little penny stocks like that that do have options. Some of them have like tons of liquidity. I've traded hundreds, thousands of contracts on like little penny stocks like that, and with no problems. The spreads can be tight and there can be a lot of liquidity. But outside of that, you kind of want to choose like, large market caps and blue chip stocks to day trade, or SPY. If you just want to like practice day trading options, SPY is the best because it has like a 1 cent spread at all times, and it has like the most liquidity of any option asset on the market. So if you want to see how like good you are and you just want to practice on SPY. It's like can be $100 to $200 per contract or less. Here's another cool tip when day trading options. Think about choosing to wait until Friday to day trade the options if you're still learning, because on Friday, and maybe you have a small account, because on Friday if you were to day trade this week's Friday expiring option today, which is Tuesday, you'd be paying a price for 4 days worth of hold time, even if you were going to buy and sell today. But if you just wait to trade the option on Friday, you won't pay hardly any time premium. The rental fee will be really low, and so you'll get almost like raw stock cost, which is great. So it'll be a lot cheaper, and you'll basically make more return on your capital because you'd have to be putting in more capital for the same return 4 days earlier. So based on your capital you're putting in, you'll get a much better return. You put in $100, you might make $600. Pretty awesome. Friday expiration are a great day to trade options. Depending on your brokerage though, you may need to sell your option back before 1 or 2 hours before closing, or they're going to automatically close it for you without your permission. So, depending on your brokerage. Cody, did you have a question at all? No. Okay.
No, my apologies.
No problem. All right, let's get the focus back in. Hello. Okay. So anyway, all right, well, looking back on this chart now, so this is an obvious uptrend. Once it hit the bottom there, it was an obvious uptrend, but remember what I said before, if any of you listened to my previous sessions, that the magnitude of the trend matters. So like this move here, I'm going to remove these lines so you'll be able to see this. Just put this over here. And then how do you keep it going? Stay in dry mode. Okay. So on the big scale, looking at this from a larger perspective, you essentially have this as the first sort of like identifiable zigzag. And so when you start to see something like this going on, where it's going up and then down and then up and then down, and yes, that is an uptrend, But you got to know that that's not a bigger magnitude uptrend than this one, because this zigzag size is so much bigger. So that uptrend down in there, yeah, it's uptrending, but unless it can get all the way over the top of this point, then overall it doesn't represent strength enough to negate this big trend. So you can kind of know that this could be short-lived, and when it gets like to this halfway point, it could be in jeopardy as far as like how much this trend can continue. Like, had it been stronger, had it went like that, like straight up and then pulled back a little bit, now you know that the strength of what's going on is I gotta get that off in there, is part of the bigger move. I'm stuck trying to get rid of this little line. That's funny. Does that make sense? Yeah. So the size of the zigzags do matter, and they tell you, is this something that's, you know, smaller in price action than the bigger thing that's going on. So if you look at like what's going on the big side, I mean, you have this boom, boom. In retrospect, I mean, during the day, you're not going to see it like that. Obviously, you're going to see the little lines, but you can kind of be thinking, hey, this is forming kind of a bigger line, part of the larger zigzag, right? So you kind of start to pay attention to that, because how the price eventually breaks any of those bigger zigzag points can change and negate that larger zigzag. Had this price gone up above this zigzag trend, it would have put into question that this was a trend. It would have to go through it though. But if it just touched the top and started to come back down, that would have been what's called a double top. And if it was starting to come back down, it would have meant it's rejecting, trying to go through, and it would have been even a more serious indication that there's no way in hell we're getting up above that point, and that things are, let's go back down, basically. And the market is constantly testing prices like that. That's really what's going on. Like if you've ever watched pre-market action on some kind of a news catalyst, and you'll see a huge spike, and then you'll see it run like way up, and you're like, good Lord, I gotta get in that. And that's like the worst time to get in, because what you'll notice is it then pulls back, and it can pull back halfway, all the way, you know, down, some of the way, whatever. But what just happened was essentially everyone said, you know, how much is this worth? They don't know yet. It's like they're probing. Everyone's probing together. You know, when are we overvalued? When are we overvalued? When are we overvalued? Oh man, it looks like we're overvalued now, and it starts falling down. Well, you know, that's also what's been happening with the market too, with tech stocks. So on a daily basis, things got overvalued, and that's what happened. We had this huge correction and pullback, and meanwhile, companies are still making money. So imagine if you pulled back and stayed there for a year while companies kept making money. Well, eventually you'd be undervalued. So what's going on right now in this like 3 weeks of waiting we've been going through is catching up again with the real valuation of the companies, and it's gonna be undervalued soon if it's not already. So we're already seeing some of that positivity in that direction today. But I do have a thesis on like where the market's going to go tomorrow. I'll pull that up because I'm sure that's going to be informative for you guys. Let's see, delete, get out of there. Okay, so back previously, there had been levels that had been tested and that had bounced off of that represented a lot of either bag holders or people who were bullish, and those levels became the support and the resistance moment levels, and they've come into effect on this correction, which is, it's been quite fast at sometimes, so it's like borderline crash, you know. And so that's what these orange dotted lines are here. They're previous strength support levels. And we saw yesterday the market bounce at 322. You know, with my orange dots, I had predicted 324, but it's not an exact science, and it's easy to be a couple points off. But it bounced off of 322, and you can bet I put a line right there because it was, you know, the market found that bottom. And what happened was it found a bottom last week as well, and that was down here at this red line. And the previous week is when we had that kind of like the biggest crash fall, which was still a correction, but it felt like a crash that day. And it created this kind of zone here of support and resistance, which I call kind of like the second zone. The first zone was the high of the market, all the way down to the top of the second zone. And this second zone, which happened last week and a little bit of the week before, was in this range. And then it was, I believe, Friday, where we broke below that range, and that was not good. Wait, let's see. Yeah, that was Friday. That was not good. That means that whole range got broken through. That means a new range is going to happen, and that's what happened. Yesterday, the market found bottom at the bottom here. So now we're in like this third zone of range, like zone 3, range 3 down here. So there's 1, 2, 3. And so tomorrow, it's been quite positive, you know, the action, and it could continue. Nike posted good earnings. When companies are posting good earnings, you know, it's a good bullish indication. So depends on what happens between now and market open, but we could get continuation tomorrow. But look, if that happens, what's probably going to happen is it's going to bounce off that top line there. And what do you think is going to happen if it does that? Like, you know, it's trying to get up to a certain level. Everyone's trying to get their prices, you know, up higher. Sellers, and buyers don't want prices higher. And yet, suddenly people aren't buying at that level, and so sellers get rejected, and that becomes an area of resistance. And so then prices will start to fall because sellers that need to get out are going to start to get out, and then buyers will start to slightly come in, but the price is going to fall. And so if it's going to fall and it's not going to go up, let's see how I can get that to draw. That's a bit worrisome because it's not really going to feel good to have your prices rejected up there. So I believe it's going to test today's prices again tomorrow, but on the negative. It's going to come down into today's prices after having tried to go higher. Another possibility is that tomorrow it breaks up into zone 2, this one. The price goes up into zone 2, but then fakes out and falls back down. And then a third possibility is it goes into zone 2 and does quite well. Like we have a really strong rally. That could happen. And that would leave us hanging by the end of the day in zone 2 for there to be lots of possible trading back and forth for the next few days there. But basically you've got these zones, and we're in these zones, and we have these 3 zones set up. And this could go on for weeks, for months. We may not be at this high again for months because we have these 3 zones to chip chop around in and get prices to agree with each other. And then, you know, someone's going to come out with bad earnings, and then things are going to go, you know, this way. Someone's going to come out with good earnings, and it's going to go this way. It's a very choppy time right now. So if that makes anybody think of something and it has a question, go for it. I got the unlimited Zoom package, so we're at the 40-minute mark, but we can go for a while. I just want to make sure I answer your questions about options, about day trading options, swing trading options, Price action, reading price action will make you such a good trader. That's what I was showing you earlier. Any questions you have? Give you a second while I just clean this up a little bit. Just unmute your mic and ask away. So what are we doing? Facebook. We should take a look at Nike.
Hey, this is Justin.
Hi, Justin.
So as you're looking at your charts for options, I know when I did in the past, I had up my 5 minute and my 1 minute. As I'm actively, doing the options trading. Of course, looked at the 20 and the 180 to kind of see where it's going. But do you line up the 5 minute and the 1 minute also? You peak at the 1 minute, but really focus on the 5 minute, or how do you do it? What do you have up? What time parameters do you have up as
Right.
you were actively trading?
Right. Well, the daily chart tells me a ton because, that's what's going on in reality, day by day. So I'm always referencing the day chart, kind of flipping back and forth. And then the minute chart lets me know at like the surgical level, kind of like what's going on. And I like to see the trends at that level, because if you look at the 5 minute chart, let's go on to Nike 5 minutes here. Let's see if it pulls it up. It's acting slow. Let me pick another one.
And as I'm looking at the, as I'm looking at the 5 minute, I'm actually focusing, of course, besides setting my support and resistance lines, I'm also kind of focusing on the MACD kind of and looking at the trigger and trying to see, where those are going to, if they crossed up prior on the 20-day, I like it, or just trying to see where those are getting closer. If they're about to close up on me and cross up again, it makes me kind of move. I'm kind of focusing those on the 5 minute. Is that anything like what you do, or you do something different?
Well, at this point, I do something different, but I can tell you a lot of things about that. So you're not going to like to hear this, but every stock is kind of different. So there's not going to be any like magic setting that's going to be perfect for every stock. You'll get things to be close, but there's basically, if you were to pull up the 1 minute and you use the MACD or RSI or whatever, you're going to get a lot of noise in the signals. There's going to be a lot of noise in this because there's just too much price movement going on in total, because at the 1 minute, I don't even know how many minutes there are in a day, in a trading day, but there's probably like 1,000 minutes. I don't know. Someone can do the math for me. But on the 5 minute, there's far fewer bars. So you're going to get, less noise in your signals. However, you might be waiting for your 5 minute bar to close before you take action. And that could get you seriously 5 minute delayed, because the moment of truth might have been in the first minute of that 5 minute candle. Does that make sense? So it is a good idea to probably always have that 1 minute up, to just always have like that microscopic surgical view of like what's going on. Sometimes I'll even pull up the tick chart, and so I can just see every trade going by, so I can really know what the feeling is. And then as far as like which time is going to be best for your MACD, it's literally going to be about rejecting noise, but not so much that it becomes like too smooth. You want it to have just enough that it's giving you enough signals, but not so much that it's giving you tons of signals. So you might even choose the 2 minute, the 3 minute, the 4 minute. If you can custom type it in, you can go 6 minute. You can just check it out. Which ones, for whatever stock you're trading, and look at like the previous couple days of action, which one's giving you just that perfect balance of correct signals and not too much false signals and noise.
Great, thank you. I appreciate it.
You bet. Maybe that brings up some questions from anybody else. All right. So looking at Nike here, let's look at so we know it went up to 132, as high as 134 in post-market on the earnings this evening. Now on the daily chart, that means It is at, if it depends on how far I can go back with this, but probably it is an all-time high. So what that'll mean is there's no bag holders. So the price tomorrow will not be running into anyone who is desperate to sell. And anyone holding, it depends on their risk style, but they either may be long-term investors saying, okay, finally I'd love to take profit on this, and so they take profits, or they may be a long-term investor who says, no way, man, Nike is Nike, I'm hanging on to this forever, and this is just more good news, and it's just more, goes with my thesis that I'm holding this for 10 years. So you're gonna have a lot of people who won't sell, because Nike, just seems to be a good stock, just goes up and up and up and up. So tomorrow, I predict that there's going to be a low level of profit taking. There will be enough. There will be enough. Maybe 30 or 40% of people holding might take profits, but 60 or 70% of people will hold. So the pressure will be on holding. So you're going to see some dip probably at the open or moments after the open, either right at the open or moments after the open. It might go up and then it might dip down. But I don't think that dip is going to be an all-day downtrend of selling and profit taking all day because people hate Nike or something. I don't think that's how it's going to go at all. I think that you'll see a pretty manageable, controlled dip that will go up and then break the open again. So it's going to go down and then break the open again. I don't know if you guys can see me. Hopefully you can see me. Might try and test going back over whatever the first minute or two of incredible, enthusiastic high price came in. It might retest that and break it and go a little bit, but then there'll be another pullback because you have to have the buy-in, the push and pull, the tug of war of that. And so that second dip is going to be really defining about how bullish Nike's going to be that day. And I predict that second dip is going to be shallow. It's not going to be strong. I think the first dip will be the strongest, which won't be much. And it's going to go break the open a bit, and then it's going to try and test coming back down. And I don't think it's going to come back down to like where the first dip was. It's going to come back down pretty soft, and then it might just rally all day. Like, remember Amazon? I don't know if you guys looked at Amazon today. It might just do that. Like, actually, that's a really good example. Let me pull it up because it kind of did exactly that today. Let me pull that up. Okay, I will pull up the 1 minute chart if it's not too noisy looking. Okay, that should be all right. Okay, so hopefully you guys can see that. So it opened like around here. I can get the exact price. I think it's there. And then it immediately, people took profits, right? And then it rallied past that open again. And then it didn't like skyrocket. It went a little bit and then it pulled back, but then it was a gentle pullback. And then it went up to where, you had hoped it went that second time there. And then it gently pulled back, which is really like consolidation. It's just a breather, like I was telling you earlier. And then went back up, and then it pulled back a little bit. And then when it went back up here, you can start to see that the bullishness of the rallies, the tops, they're not holding. They're starting to be less and less and less. So it's like a lot, like this leg here was a lot, then the second leg was less, and then this third leg was less and not quite as high in distance, and this last one was like, eh. So if I was day trading that, I might sell right there at that top. We can get over like trade exits and stuff some other time, but it wouldn't be a bad idea to sell right there. And then sure enough, price drops down. Or you could wait for this confirmation right here when price action drops below that trend low, you see? And that would negate this magnitude of zigzagging. It would not negate this huge zigzagging going on, but it would negate this level of zigzagging trend. So you would know that it's going to go back down. And but then this is what I think will happen with Nike, is that second major pullback will be higher at the bottom than the first one. And it might not even be this bad. It depends. Depends like tomorrow how we run into that support zone on the market, like I was showing you. Things could get freaky by this time. I'm not sure. But Nike could then potentially just do this all day at that point because there's no limit to the high, you know. So I will probably buy options on Nike on one of these dip areas if it happens. If it just starts running out the gate, I'll still probably wait for that pullback. I wouldn't get it when it's going green, 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 because it's going to pull back. I mean, nothing goes up straight forever. It's going to pull back. So I would still wait for that pullback. Even if I got in at a higher price than had I got in earlier, it's just safer to get in during the pullback. You're going to get a better, you know, next move out of it that's more predictable than if you got in at the top of, you know, of that move and you're trying to figure out, oh my God, how much further can this go? And then the whole thing falls out from under you and now you're losing money. So it's just much better to wait for the dip every time. Even if you missed an up leg, it's okay. You're just managing your money better by doing that. Does somebody have a question? I heard some mic noise.
Yeah, actually, so when you are monitoring this, say for instance tomorrow with Nike, and we'll pretend it's, you know, skyrocketing up still during the hours. Now, when it does start to pull back, what kind of signs would you look for? What would tell you that, hey, maybe it's not a pullback, it's just actually reversing?
So the size of those trend waves, right? So let's see. What if Nike does this? Here's another example. Apple did not do super good today, you know. It did okay. But on the day. Most of the day, it was one of the weakest FANG stocks. You know, Microsoft, Amazon, Google, Facebook, everybody did quite well today. Apple did not do good. What if Nike acts like Apple tomorrow? Or like 2 weeks ago, there was RH. You know, and they had huge, great earnings. And the next day, like pre-market was up the same, you know, another double level. And then when it opened, it just kind of like fell the whole day. That also happened with IMMU recently, I think. So let's say that happens with Nike, and this is what Nike's chart ends up looking like. Well, right here, you're watching, and you're trying to see when does an uptrend start. I mean, if your thesis is, hey, Nike posted good earnings, it went up in after hours yesterday and pre-market today, and when it opens, if it dips, probably the good idea is to get calls. If that's your thesis, then you're looking to see when the uptrend, a reliable uptrend, has formed, and so you can get in. So we would watch it, and so you'd get this down action here in the first 3 minutes, and the bottom of that candle is right there. And then you get this upward motion here for 3 minutes. And you could be saying to yourself, hey, maybe that was the bottom back there, right? But you just can't get in yet because you need like 3 points to create a trend. And you only got 2. You got, you know, down and up. You only have 2 lines formed at that point. So you need a little more. If that second line went up and beyond the first line, then okay, you know, you have a confirmed breakout of the opening price and now it's, you know, seemingly in an uptrend. But that's not what happened here. It then reversed back down off of that little rally and it broke that low right there. Boom, right there. That's all you need to know we are in a downtrend. That was the confirmation. It took that long. 1, 2, 3, 4, 5, 6 minutes. It took 6 minutes for you to go, okay, we're in a confirmed downtrend because of that level that it broke right there. The lowest low of the day got broke. Oh, I hate this thing. I gotta turn off the magnet button there. Anybody who uses TradingView is probably like, just turn off the button. There we go. So see, it broke that low, and what we were dealing with before that was this lower low really, from the opening here. So we had the opening, and then low, and then high, and then if it breaks that other low, it's going to be going down to a lower low, and then that's a confirmed downtrend. And that was enough to send it basically twice the distance down there. At that moment, if you're fast enough, depending on how you've set up your trading platform, you could get puts for taking the move the other way. Because what doesn't go up either goes sideways or down, and in this case it was going down, so you can make money off that. So, and you kind of got to be ready to like turn on a dime like that sometimes. But I wouldn't, highly recommend shorting something that has been going up and it always goes up and had good earnings and a favorable, reaction from investors. Hi. Oh, okay. Hi, Rochelle. Hi. So, yeah, so that could happen tomorrow, and that's how you would read that price action on that. Let's see. Let me go back to Amazon or something that was a little bit easier to read. Let me see how Facebook did for the first couple candlesticks there. Because in general, I mean, do you get what I'm saying? Owen?
Yes, I do actually. That pretty much explains what I was looking for.
Yes. And it's just in reverse. I mean, that's what I'm about to try and show you. I'm trying to find another one where the candlesticks are kind of like going up on the day. I don't know. Just can't seem to get it to pull up. Welcome, Crystal. Here's something coming up. Must be my internet connection. I just don't want to find a thinly traded stock like that. Oh, Microsoft probably. Well, no. That didn't do it. Nothing did well at the open today, did it? Who can think of a stock that's very liquid that did well at the open today? Like for the first 30 minutes? Probably nobody. Probably because there wasn't one.
Was Roku pretty good? I think Roku jumped out the gate pretty
Oh,
good.
that's right. He's right. It did. And you know what? It didn't jump right out of the gate. I'm going to show you where I sold Roku and was so pissed off. So I believe I sold Roku like right down in here, but I didn't finish putting my order in. Thank God, But then when I went back to that screen to see that I didn't finish putting my order in, I was like, oh, I should put it back in. So I put it back in and I immediately thought, but wait a minute, maybe I should check the chart. I look at the chart and it was already doing great. And I'm like, no, I think I had 5 or 10 contracts and they were up on the day. And look at how it did that day. It did pretty swell. It did well. Bad, human error. It happens to us all. I mean, you want to get your mistakes down to a minimum, but it happens to us all. But so Nike could do that. This is a very good example of what Nike could do. It could dip at the open, and so where to get in if it does? In this Roku example, so you have down, and then up, and it didn't go higher, and then down, down, down. So that's 3 legs. I'm just going to illustrate it for anyone not able to follow my mouse too good. So it went down and then it went up to there and then it went down again to this low, and you're just sort of watching that and forming these mentally, these lines, these trend lines in your head, or you're drawing them if you want, but you're forming them in your head as that's happening, and you just get used to seeing that. As you get to be a better trader, you just get used to seeing that. So then it did this, essentially, So that's still saying, hey, you know, we're in a downtrend, right? Well, right about here is where that thesis is starting to break down. And when it did this and broke that level right there, I'm not going to go all the way up right there, because what I'm showing you is that when it broke this level of that previous zigzag high, that kind of negated both this zigzag and this zigzag low. And it essentially connects this to wherever we're going now, which it goes like that. Essentially, you know, in theory, because it negated the other two, essentially that's what we're looking at. And that's quite a leg up on whatever this zigzag is doing. So you can almost start to get the feeling that the trend is reversing in there. And when it does this pullback right here, and for sure does this, we have a new trend going on that seems to be powerful enough to be overtaking all these different highs. And it's confirmed at that point. 1, 2, 3, right? It's confirmed. So somewhere in here would have been like the most conservative but fully confirmed moment to say, hey, this is definitely got a chance that it just reversed and that that dip was back there and we're going to be going up from here. But a good place to try to risk the entry would have been down in here in this consolidation thing. The action slowed down. It's not pushing down, and this, you know, making a higher high over this candle is good. And this not going lower than this candle is good. So like these three candles here, it's like it's all good stuff. And it's slowing down. If you're really a good predictive trader, you maybe could have even got in all the way back here, because it's really slowed down. These angles started to slow down. And the reason why it would have been okay to enter there is because if price went below this point, again, you could just get out, because you'd know, oh shit, you know, no, this is not going the way I thought, but at least I took a chance, you know? Because if you did get in here, somewhere, say down in here, which would have been nice, by the time you have that fully confirmed trend, you've already got 187, 184, you've already got 3 points of gain additional just for risking that, based on some of the other factors there. The fact that you could just get out if it broke that low, and the fact that it kind of slowed down. There's some things going in your favor there to try to get in early, to risk it. And then, yeah, it did pretty good from there. And, you know, unless a larger trend is broken, you can just stay in. You know, if you've got option contracts, as long as the trend doesn't really get like heavily broken, you can stay in. Like I would get out here if I was staying in for a long time. This also might be worrisome, coming back down here and it breaking this low here. So I might get out here. I love having multiple contracts for that reason. I like having at least 3, but I like to do 10 or 100 contracts. And the reason is so I can just take some off here and there. Oh, that was a nice rally. All right, let me sell 1, 5, 10. All right, and it's coming back down. I'll just wait, check on some other stocks, come back. Ah, look at that. All right, good. Oh, let's take another few off there. You know, by the end of the day, I'm, you know, out of 90% of my holding. Even on something like Amazon that might be going up and up and up and up and up, I'll still be kind of taking off at points, unless it's just a very rare, obvious, perfect, blissful upward trend, which does happen sometimes. Cool. So, you know, Nike tomorrow could go a lot of different ways, and you got to be on your toes, and you got to be reading price action. You could make a lot of money tomorrow on Nike if it does what these good earners that go up a lot and open and dip at the open do. If it does what a lot of these ones do, you know, you could get 10 or 20 contracts and make $10,000 to $20,000 on the day. It could be pretty serious. You could do really good on Nike tomorrow if it does what we want it to do. One of my concerns is that market resistance that's kind of like hanging right over everybody on the market's head right there. So that's one of my worries on that. However, for Nike, it doesn't really have resistance up there. It just has, hey, are we going to follow the market today, or are we going to do what Nike does? And it's hard to say what's going to happen with that tomorrow. It could depend on gold. It could depend on the dollar. It could depend on oil. It could depend on Trump. It could depend on news. It could depend on so many factors. So, gonna have to feel it out. Gonna have to be a trader. That's part of being a day trader. It's just following the price actions. Best thing you can do is learning to read those trend lines and all that. Yeah. All right. Let's see. So who's like new to option, like very new to options, and maybe has like a question that's like pretty newbie question, and that's totally okay. Let's get you through that. And ask one of your like, man, what is the whatever? Go
All right,
ahead.
I got a pretty stupid one here.
Yes.
So entering into an option, if you were to buy a call, would you ever, if you were in a bad position, would you ever go back and buy the put to get yourself out? Does it work that way?
Absolutely. Oh, absolutely. I did that yesterday or the day before with my Amazon holding. You can buy it as like insurance. So I have a longer term Amazon option. But then just to protect it on that like day, which was really red, and I didn't know if the market was going to break through lows and then break through further lows, and just like this could be a day to remember, in history.
Yeah.
So I bought an Amazon put that day and made like $5,000 on it, just because it did so poorly. Amazon did so poorly and the put did well. But I still kept it until today, in which I released it, because then Amazon showed a lot of bullishness and reversal. So you can do that, Yeah, you can do that. Yeah, options are a tool to do whatever you want with them. You're like, hey, do I need to get some contrary direction here? Because you can kind of like freeze your position that way, which can be good. During times of uncertainty, that can be really good. There's other ways to do that can cost next to nothing, which can be very cool, but it does require margin. And in my case, I have a $60,000 option, one contract on Amazon. I have a $60,000 option contract on Amazon. And so to counter that with something that would have required margin, would have required like $450,000 of margin. And yeah, that's not going to happen right now. So I
like
have that.
close today.
Say again?
I said, I don't know. It looked like you were getting close today.
Yeah, I did pretty well. Thanks.
Good job.
So another thing about options that some newbies ask a lot, and it comes up, and it's a good question because it's not necessarily evident, is that this is going to sound kind of, newbie question to many of you, but some people don't know this. You don't have to hold the option that you buy all the way to expiration. You can trade it back at any minute, hour, day that you wish. So you buy the option at one price, and if it goes up in value, you can sell it right then, the next day, the next hour, whenever you like. You do not have to wait for that expiration point that you picked. The expiration point, essentially, I like to think of the expiration point as my insurance. So I buy an expiration that goes with how much I'm concerned about the security of this bet that I'm making. Is there a lot of uncertainty that could happen? If so, I'll buy more duration. I typically, like right now during this market, I'm buying like 4-month options, even if I'm trading them for 5-day swing trade, 7-day swing trade, because I just want all that extra time and rental fee that I'll get for all that time on my option value if the price were to decline, to kind of like as padding to protect it, to protect some of my capital, if you will. If I were to buy a short-term option and the price went down, I don't have that protection because there's no more, duration of rental fee built into the option value anymore. Basically, when your option goes down to 0, all that's left is whatever rental fee value there is on it, the premium, the time, the theta value, the rental fee value for that expiration. And so if you buy a lot of time, it can be kind of a good way to give yourself some insurance, because if the price goes down on you, then you're gonna have maybe 30% padding if you buy 3 or 4 months out on your capital, which is pretty awesome. So I'll do that, and I'll buy more deeply in the money. I spend more money on my options, but that's because I choose longer duration and deeper in the money for the strikes, and that gives me more padding, less loss when the prices go down of the underlying, and actually I get more gain because I bought deeper in the money. I get more gain per underlying point move because I'm buying like a delta 0.75. I get more gain per point move than most people do because they buy at the money or out of the money, which only gives you 50 cents or 25 cents per point move in the underlying. So, little by little, you guys will get the hang of all this, and we'll get some questions about that, deltas and thetas and gamma, but in the end, it's just, you can play options kind of like a cowboy and still do great. You can just go like, I don't know how that works. I just buy low and sell high, and you'll still do well as long as you trade it, and you're not like afraid to sell it because you didn't know that you couldn't sell it because you thought you had to hold till expiration and all these other things. But if you just like are a charging cowboy about it, and all you do is find something that's at the right price, and later it goes up and you sell it, then you can rinse and repeat that and do well. So it doesn't have to be a mathematical, academic, like calculus nightmare to do well with options. You can be all right. All right, well, does anybody else have like another question they thought of? I'll make room for like one more here.
Hey, Ivan, Prabjit here. Can you
Yes,
hear me?
hi.
So, the thing is with options, right? Like, so what is if somebody wanted to invest cautiously, so is option is a good thing, or they should avoid options? Like, if they can hold, because share can be hold for a longer time, and people can avoid their losses, right? With option, you have a limited time, so you have to act in that limited time only. So, like, what do you recommend for those who basically don't want to get more losses? Or
Prabjeet, can you type your question, because it's not your accent, but it's hard to hear you. I think the mic is a little bit. It's
is
hard
it
to hear. Go ahead and type your question. I'm going to answer somebody else's question. I noticed that there's 6 questions typed over there. I'll be with you in a moment. Okay, so yeah, did we mute him? Okay. So some other questions that came through. You said SPY is something you could trade daily. Would you be able to do the same with TQQQ? I think so. I haven't checked the liquidity of the options on that. Okay, so maybe it is quite liquid and can be fun to trade. What is TQQQ? Is that the inverse of the Qs? I forget what TQQQ is, or maybe it's 3x the Qs. Yeah, I think that
It's
might.
3x, I'm pretty sure.
It's which one?
It's 3x. TQQ is 3x QQQ.
Yeah, that's what I thought. Okay, cool. Yeah, so I don't know about the liquidity of the options on that. How about you? Have you ever checked it out?
That's what I was just thinking of. I'm pretty sure I have in the past, but I can't even remember.
You
And
guys are
actually, I was
fucking
gonna.
insane. Go for the TQQQ and options on that. I bet they don't even allow that because I think that's a leveraged ETF. I don't think you can get options on a leveraged ETF. But if there are, like, holy crap, that's like 30x leverage if you can get a, say, at the money this week expiration on a TQQQ, triple X leveraged QQQ. Phew.
I think I actually just probably traded stock, but I'm pretty sure I do remember seeing that there was options for.
I'm
Yeah, it
surprised
is options. It's options.
Yeah.
it has options. That's crazy,
Oh
you
yeah.
guys. Wow. All right, everyone. From now on, we're gonna only trade TQQQ because, good lord, we're gonna make a fortune. I'm gonna start to check that out. Holy cow! Is there a
Actually,
triple X SPY?
I don't know.
Yeah, that'd be
But
cool.
I was going to ask you actually the because you kept mentioning that you're checking liquidity, and by that, what are you checking? I'm guessing
Okay,
volume and open
awesome
interest, but
question. Yeah, so volume and open interest. So open interest shows how many people are currently holding contracts. That's kind of cool. And volume shows how many trades have occurred today on that contract at that strike at the expiration. By the way, like all the options on a stock are like mini stocks. Every strike and every expiration, it's its own stock. Like I've had questions like, if I buy the 300 strike, can I sell it at the 305 strike? And like, yes and no, but no. You if you buy the 300 strike, that's like a stock that you bought. And if you want to sell the 300 strike, you have to sell the 300 strike just at a higher price. It has prices, just every one of those strikes and every one of those expirations is kind of like its own little mini stock that's dependent on the underlying larger stock. And yeah, so I just wanted to clear that up for anybody.
so with that open interest and volume in mind, like what are you referencing those numbers with? Like say it's a stock you've never looked at. Like for you, for example, TQQQ, you're seeing open interest, let's just say 300 and volume 400. What are you referencing those numbers to see whether it's liquid or not?
So one of
Or
the
is it?
things you'll notice, yeah, good question. One of the things you'll notice about options is they're far less liquid than stock. Just in general, across the board, across the whole market, they're far less liquid than stock. So for me, what you just said, like 300 open interest and 400 volume, for example, for me, that would be like quite liquid. Even though it sounds low, that's pretty liquid. And I would just double check that by looking at the spread. And if the spread, you can't really get as good of spreads on options as you can on stocks. It's just, that's a given. But because they can return 3x to 10x to 20x the return that a stock can, you're not so concerned about it having a penny or a 10-cent spread. You can almost deal with a 50-cent spread because if the thing goes up, from $1 to like $12, what difference does it make? You just made a fortune. So, this I check the spread and I see if it's just like reasonable, and so if something had like 12 volume and like 25 open interest and the spread was like $1.50, that'd be a little bit worrisome, bit much of a kind of like a little bit illiquid. But if it was like a slow stock, maybe it was an ETF and it had options and it was something slow that I wanted to do a swing trade on for like 3 weeks of duration holding, I would just put in my bid at the mid, and that would be the fair price. And I would put it in at the mid and see if I get it in the next hour or two of slow movement. So that's for a slow. That's the worst condition that I would accept such low liquidity. But to day trade an option, you probably want to see those numbers moving right in front of your eyes. Like the volume should be like, there should be good volume, and the spread should be quite reasonable and in accordance with your thesis of how far this thing is going to move. If it's something like Party, PRTY, and Party was at like 2.5, now it's at 350, I think. If it's something like that, but it took like a week for it to make that move, and you're getting in and the spread is 10 cents, that's actually a lot, because every day it's only moving in total, the stock itself is only moving like 20 cents. So that means like, you know, you could buy at the ask at the beginning of the day and then sell at the bid at the end of the day, and you'd be at the same point. And so, you know, and yet those options are very liquid. There's like 1,000 volume and thousands open interest. So, but it just doesn't line up necessarily always very well. So there's a lot of factors, and you just got to kind of feel that out and say, hey, no, I'm going to get screwed here, or this seems good, or this is awesome. I mean, I think if you're going to learn day trading options, SPY is just perfect. It's so liquid. So yeah, that was the question about TQQQ. And somebody said BYND. I guess people are just calling out stocks. Maybe, oh, that was earlier when I was asking for some stock recommendations. Is there ever an instance where you would actually exercise an option, or is it best to just sell the contract? Like that just happened to me with Ocul, OCUL. I had, I think just one contract on that, and I didn't even notice, but like at the closing bell, it rallied right up in the money for me. I had already given up on it. I was like, oh, it's in the trash. But you know, that just goes to show you, and I've learned this many times, if you have an option that's near worthless and you want to like save the money by selling it so you can get your $5, $10, $15, $20, $50 back, $100, $150 back, I mean, kind of don't, because unless it's complete, you know, you really are really sure it's not going to go in the money. But I've had many times where I was super surprised to see that something just went through the roof and closed in the money, and I would have made back everything I ever lost, and I should have just held, because is that worth $5? I mean, just keep it, just to keep the $50 riding, because it might turn into like 400 right at the end there. And anyway, that happened with me with Ocul, OCUL, and I didn't know it. So later that day, I was just checking my account and noticed that I got an exercise. And so on Monday, I had 100 shares of Ocul at 9. And if Ocul went up further, that'd been very cool. But unfortunately, Ocul went to 8.86 or something pretty quickly, and I just sold. But the thing you should know is that different firms may have an exercise fee. So if you get exercised automatically like that, which most brokerages will do, but you can give them instructions, don't ever exercise me even if I'm in the money, which would be kind of stupid, but it depends. They're going to charge you like $35 to exercise you. So to exercise your option might be like $35. And in the right cases, you might not want that to happen because you're only going to make $4 or something, you know. So it can kind of suck, but in many cases you do want that to happen. Like something like Tesla, like if that exercised, then on Monday you wake up with the price at such and such, which was your strike. That's basically where you get your shares at, your strike, and then the stock is way up here, and then it's going up on the day. You're going to be so glad that you still have that stock and that it got exercised and whatnot. But remember that if you do get exercised and holding the stock means that you need more money than you actually have, then on Monday, you could go as far as maybe Tuesday or Wednesday, but basically you're going to get a margin call for them to say, hey, if you want to hold that, you've got to like deposit more money in your account, man. And but you don't have to. You can just sell during the day at some point. Maybe, you know, a couple hours during the day, the stock has gotten to where you would love to have sold anyway, and so you sell there and you sell your actual shares. Now you're out of the margin requirement, and overnight and over the next 2 days, all that cash will settle, that whole transaction will settle, and you'll be fine. So there was a kid like recently, I guess, who like, I don't know, you guys probably know the story, he jumped off a bridge or whatnot because maybe it was an oil contract, I think it was a Robinhood trader, I forget what happened, but had he noticed that on Monday, what happened, I think, was he got a vertical, and it meant that on Monday, the $750,000 that they were requiring him to deposit would have actually done what I just said. It would have exercised, and he would have been able to sell it that day. But actually, he had a vertical, so it would have actually counter sold itself, and he was only liable for like a couple $1,000. Oh God, just tragic, just tragic.
Hold this right here, just like this. Just like look at my hand.
No, yeah, somebody was. Go ahead, Justin. I think, yeah.
I apologize. My phone came off mute. My apologies.
Did you have a question? No? Okay. So, yeah, that's just tragic about that kid, though. But, okay, any other questions here? It says, what is the break-even point?
750,000.
Yeah, so you know the story. Yeah. Yeah, 750,000, yeah. You said, what is the break? Somebody said, De'Ara said, what is the break-even point? What does that mean? Like, what is the break-even point? Okay, so let's say you buy there's a stock, it's at 100, and you buy the strike that is 100. Let's say it's 100. You buy the 100 strike, and the stock is at 100. And you buy 1 month duration, and it costs $12 per share, so $1,200. Everything you're paying is for time rental, and essentially, how high do you need the stock to go for you to break even on the $12 you just paid? Is your strike plus what you paid. So 100 plus $12 a share would be 112. So your break even is 112. So it means you'll still get some money back if the stock by expiration is above 100 but below 12, but you won't have broken even. You'll have lost a little bit, but you'll get some money back. But if the stock price is below 100, you won't get any money back. And if the stock price is above 112, you'll have made money. Like if it's at 115, you'll have made $3 times 100, roughly $300, except times your delta, but just roughly in the cowboy options trading room, roughly $300 profit on top of your break even. So hopefully that answers that break even question.
Thank you.
Yeah. For safe investment, what do you prefer, shares versus options? Okay, so for very safe options swing trading, you would do what I was saying, which is you would get like a lot of duration. You know, if you were going to do a trade that was going to last a month, 3 weeks, you might get 3 months or 4 months duration. And from that point, you would also go down in the money to about 0.75 delta. And delta, this is a very cool trick for some of you. Delta kind of represents the probability of success of your trade. So when you buy something at the money, it's at 0.50 delta, 50 cents delta, 0.50 delta, or 50% delta. And therefore, when you buy at the money, you have a 50-50 chance of making money by the time the option expires. Of course, if you sell before that and the stock went up, you have a much better chance than 50-50. But by expiration, it represents a 50-50 chance of making money. If you get the 75 delta, you have a 75% chance of being in the money by the expiration. If you get an out of the money option, they're usually 20 or 25 delta. You have a 75 chance of losing all your money, and 25% chance of making money. Yeah, and out of the money options are called lottery tickets, and we'll go over that many times, probably. But I definitely don't advocate out of the money options except for certain interesting scenarios, which we can get into, maybe earnings, different scenarios. All right, safe investment. Do you ever put so real quick summary on that? What's the safe investment? The safe investment, if you're going medium term, is the options deep in the money, 75 delta, about 3 or 4 months minimum. Can be 6 months, can be a year and a half. I would prefer that over the stock because of the time duration. You're ensuring and padding your losses. Whereas over in the stock, you would be losing money linearly and even below your strike price, you would be losing more money if you didn't get out. And yet with an option, okay, with a stock, if it hit that strike price, you can consider that kind of your stop loss. And let's say you got out at that point. Well, with the option, you can hang on. You don't have to sell if the stock goes below your strike price, and it can come back up and go back in the money. You can make money. And that's kind of cool. One of the cool things about options is you can't lose more than your stop loss amount, the amount that you put in, and yet you don't get stopped out. So there's quite a few benefits to getting the long-term 75 delta option over stock. The only reason I might buy stock ever is to have voting rights, bragging rights, voting rights. But you don't make as much money per capital invested, and you put your money more at risk with stock versus options, if you do options correctly in the manner I just mentioned. Do you ever put a stop loss in for an option? You can do that. I've done that on a couple occasions when I have a lot of things going on, and I know, okay, if this falls below here, but it's a little bit hard because you've got to be kind of an expert, because you have to calculate what is the price of the option going to be if the price of the stock goes, here, because you don't want to sell your option just because of a price change in the option. You want to sell your option almost always based on what's going on in the underlying. Did your thesis change? Are you screwed? Did the stock go against what you were hoping and is fully confirmed and negating everything you were going for? Well, that's the point to sell. That's the stop loss you're looking for. The stop loss point you're looking for is the price that you would sell the stock that you're holding the option on, because that point is bad. And so then you would sell the option there. And now what you got to do is you got to figure out if it goes there by X and X date or time or whatever, how much will the option have declined? And that takes a bit of math. You have to use delta and gamma and maybe even theta if it's multiple days. So yeah, that's a tough question. I mean, just, if a stock goes against you, just get out. There's another option for you. Just sell, preserve your capital, get in later, get in something else that's maybe more of a short thing. Get really, really good at selling. That's how you make money in day trading or trading and swing trading or trading in general. Get really, really good at, be better at selling than you are at buying. Absolutely. For day trading, which expiration date will you get more gain? The Friday of the week or the next Friday? So I think that person is asking if you would buy like the current week's option or next week's option, giving you almost like 10 days or 7 or however many days are left, more days. It depends on the delta. And if you're buying at the money on both cases, then the shorter term one will give you more gain per price move. But if you were to go and buy the other one and go in the money a little bit, you could get the same gain going on the other one, and it would actually provide you a little bit of padding on that trade. But I don't fully recommend spending much money when you're day trading options. Just get the at the money nearest expiration, or maybe one strike out of the money if you expect the price to be going through it, or one strike in the money if you're kind of in a consolidation area. All right. Large spreads on TQQQ options. Well, right now, maybe tomorrow those spreads will be a little bit more accurate, Robbie. Maybe it's not accurate right now. Or unless you know from experience. Yeah. So, but if you just looked it up, maybe right now the spreads are wide, but tomorrow maybe they'll tighten up during market hours. Let's see, Brandon asks, are your call outs going to be pushed out via notification to the Gold and Gold Plus members? Yes, thanks. I'm getting that all set up. Right now, I don't know how it is today, but ARCQ was something we were going after, and Block. So those went out today. So sorry if you missed it. And if anybody here is not in the membership, then woohoo, you just got a free recommendation of what to get. But it was too late. Today was it was at a much better price point. Block and ARKQ were some swing trade alerts that went out. Do you consult one-on-one? I do. Unfortunately, depending on what your budget is, I charge $100 an hour for that one-on-one. For some people, that's perfectly fine. And for other people, I understand if that's a problem, but I have 7 kids, a family. I get 2 days on the weekend. We have the market hours, and then we do these sessions at night. And I do a lot of research. I custom program a lot of things for the market. And, you know, I gotta have a life. So if we do a one-on-one, I gotta charge $100 per hour. And hopefully that works for whoever is able to do that. What is the preferred percentage to exit an option when you're losing money? So, you know, with stocks, you often hear 2%, 5%, 10% as your stop loss. But because options can give you a return that's 3x, 5x, 10x, even 20x what the stock would be giving you, you can't use a 2% or 5% or 10% percentage loss. So it's really difficult to say what that number would be. Some people use 50%, but that could be alarming to anybody. You're like, holy crap, you know, I'm going to lose 50% on this. But the reality is that you're going to make so much money on the ones that you make money on that truthfully 50% is actually not a large loss in option land. You know, I've made 7,000% returns before on options. So you're gonna get it back, you know. But the main thing to pay attention to is the stock itself. If the stock is fucking sucking, then get out. I mean, that's the thing, that it's so hard, and I say it harshly like that with the cursing, because, you know, I really want you to pay attention that if the stock sucks, don't be in it anymore. You know, and I can read charts really well, like this one that I just have up here. ARKQ is a great stock. It's so reliable. I mean, look at that, besides the March crash, look at that, it's just straight up. If you can't tell the difference between that and like Ford, you know, that's not good. You got to improve your charting skills, because this is good and this is not reliable. This is a mess. It's a little bit reliable, but not much. So that's how you figure out if you want to sell your option, is if the chart is showing you that it's not a good investment anymore. You know, like Lulu, okay? I was in Lulu for the last 2 weeks because I love the Lulu stock normally. However, earnings came out and it tanked, and you know, you can see that overall Lulu looks fairly okay compared to like Microsoft. It's another one of these stocks that just continues to go up and up and up, and it's pretty smooth. It's a pretty smooth ride, okay? And you should get good at kind of reading that. It's very reliable, pretty smooth. There's not any sharp like bam and it's not violent, right? So, but then it went down, and my option went down 90% in value because of the earnings volatility crush as well, which is something we can talk about sometime, another time. But I was like, well, that's that, you know, and it's okay because, you know, I know I'm going to make those 200, 500, 1,000, 2,000% gains on something else sometime, and it all evens out in the end. But lo and hold, I do know that you should never sell your option really when you're in that situation, just to get back that little 10% of capital, because you never kind of know. And look at what happened. Lulu reversed. It put in the strongest bullish candle that it has put in pretty much ever. So tomorrow it may continue, and I may be up around 75% loss, and we'll see where it goes from there. That could come all the way back up to, who knows, being even profitable, but I don't expect that. I'll probably get out when things are happy enough for me, or who knows, maybe if I'm 80% got my money back, I'll just keep riding it out to expiration, because it might go up to 110%. I might make a little bit more, but there's renewed hope. So I don't know what my point was there, but basically, when to sell your option is more based on the stock and what the stock is doing. And I got screwed here. It just fell so fast. I manage a lot of positions, and honestly, that one just got away from me. And I would have liked to have sold maybe for 60% loss. I would have been cool with. So about Workhorse tomorrow, that's actually, we should take a look at that, because I need to, as a matter of fact. I was in that, and I got out around 30 or 31, wherever it was there, 31, and I was in that from down here. That was an alerted swing trade, and we did really well on that. I don't remember the return, but I think it was over 120%. So, I mean, based on this, I don't know what happened in after hours. Let me see. Yeah, it's basically did the same. Based on what I'm seeing there, that's a pretty strong bearish candle. And so it probably is going to continue further tomorrow. Tomorrow might be a little up day. It might have a little candle right there, or it might try to tease you and take you up towards the top of that candle. But unless it breaks the top of that candle, it's not going the other way. It's going down, and this is very strong. So it's either going to continue down, which that's what I really would expect, and that momentum's going to start to slow over the course of days, and it's going to bottom somewhere around here. Heck, it probably will find support at previous resistance, which could be right here at 24.50. But I might even bet on it going lower, down to 23. And you could average in. If you expected to get like 3 contracts or 10 contracts, you could buy 3, or you could buy 1 on one day, see how it goes. It drops lower, then buy another one, drops lower, buy another one. But yeah, I would definitely want to be in Workhorse, and I would want to buy a longer duration, like 2 or 3 months. A, to protect my investment, my capital, just like I've been telling you this entire time. That helps protect your capital. But B, because of the USPS contract potential out there lurking. If USPS awards it the contract, my analysis shows that the price could go to $90 to $110. So it could be really great to be sitting on that. But it doesn't look like everyone agrees with that analysis, because otherwise the stock would be rallying even harder than it is. So maybe the real destination price is going to be like 60 or 70 if they get awarded the contract. Based on the price action in the chart, that's kind of like how I would modify my own fundamental analysis. But if they don't get awarded the contract, there's been a lot of positive talk about Workhorse in general anyway, because of different sales they can make for their vehicles for different companies. And so they have a lot of value despite. And so on that basis, on a good pullback to 24, 23, 22, 21, 20, boy, if it got to 20, that would be awesome. That's where I would start to get in. And if I miss the big, huge USPS contract, well, that's all right. Because I can always buy the dip and get a killer return that day when that's announced, and you can just day trade that and do quite well. There's lots of ways to make money. How do you go about setting a stop loss and target profit on options? We'll have to probably go over that another time, because I think we're getting to the end of our session, and that's going to be a little bit more of an explanation. Oh, there was another question up here. Outside of these classes you are providing to us, what outside resources, books, YouTube, podcasts do you advise for further study? I'll try to add some in some areas. Oh, I can tell you, Game of Trades on YouTube is just one of the best chartists. That guy understands charts so well, way beyond me, and I'm so impressed by him every time he puts out a video, and he does it fast, and he gives you, so there's probably already one today for what went on today. He's very active, and his analyses are really on point. So that's Game of Trades, the channel on YouTube. I've got 5 kids, 1 wife, and 1 wife equals 7. Can I get a discount for having similar holdings? Oh, that was a private comment. I wasn't supposed to read that. How do you go about setting a stop loss and target? We already got that. How many days you offer the trial membership? And what about Tesla? The membership and the trial and all that can change on a week-to-week basis depending on what the admins are setting up. So I don't really pay too much attention to that. So ask them in the group. Just go ahead and post a message in there. Thank you to Mike for his private message saying good night. And Prabit says, I got stuck with the shares. They're filing bankruptcy. Do you have any suggestions? Well, you know, what is it? VAL, I think you said? Well, it would have to have a Q on it, right? So it's not in bankruptcy yet. ValPQ, it's probably this one now. Yeah, I don't know, but I can tell you this, that after a company emerges from bankruptcy, on average, those stocks go up, I think, 60% within the first 100 days on average. Some of them go down, some of them go up, some of them stay in bankruptcy and die. So, I don't know, it's dangerous. Hey, everybody, thank you very much for being here tonight, and looking forward to tomorrow. Looking forward to tomorrow. See you there. Good night. Good night, all.